Your mortgage approval could already be dead in the water and you won't find out until years from now. That's how credit works. The damage happens first, the consequences show up later. Let's go. The credit card that you open for points, the interest-free financing, the random line of credit application, the car loan you didn't even need, those decisions, they don't make the banks think you're smart. They make the algorithm think you're becoming desperate. And the craziest part here is I've seen people with perfect payment histories, high incomes, and six figures in savings get punished because of the things they did years earlier, trying to optimize their credit. Meanwhile, people making less money, they get approved easier because they understand how the system actually works. I'm going to show you the 5 things secretly controlling your credit score, the biggest financial trap Canadians are falling into right now, and why one bad credit decision today can quietly cost you tens of thousands over the life of your mortgage tomorrow. Here's the thing that no one explains properly about credit. There are 2 completely different conversations happening at the same time. There's the internet version of credit, and then there's the lender version of credit. The internet, it tells you to chase those rewards, open more cards, build available credit, and finance everything at 0%. Use credit hacking strategies. But lenders, they don't see smart, they see risk. Your credit score, it's not a reward score. It's not a responsibility score. It's a risk score. The entire system is trying to answer one question. How likely is this person to become a problem later? That's it. And the scary part is you can look financially successful to your friends while quietly looking disastrous to the banks. I've watched people destroy their borrowing power trying to win those free flights. I've watched clients pay higher mortgage rates because of credit cards they forgot they even opened. And by the time that most people realize what happened, the damage is done. Because credit damage, it ages slowly. A bad decision today can follow you for years. That's what people don't understand. You don't apply for a mortgage and suddenly start preparing. The mortgage approval was being built years earlier or destroyed years earlier. So let's break down the 5 factors that secretly control your credit score. Because if you understand these, you can dramatically improve your financial future. And if you ignore them, well, you can quietly cost yourself tens of thousands of dollars. The first factor is payment history. This makes up roughly 35% of your credit score. This is the heavyweight champion of credit. Pay your bills on time, every time, no exceptions. And here's where people get confused. If you're a few days late, that usually doesn't hurt your credit. You generally have a 30-day grace window before it reports. But once you cross that 30-day mark, the damage starts. And those late payments can stay on your bureau for up to 7 years. 7 years, one missed payment today can still affect your mortgage years from now. That's fucking insane when you think about it. And if things get really bad, collections start. And collections, they're brutal. Because once a debt hits collections, the entire system changes against you. Now the collection agency owns the debt. They know you'll eventually need credit again, and they know time is working against you. So if you ever get a collections notice, deal with it immediately, not later, immediately, because unpaid collections can absolutely destroy mortgage approvals. The second factor is utilization. This makes up 30% of your score. And this is where credit hacking quietly destroys people. If you have a $10,000 limit and you're using $9,000, the system thinks you're close to financial stress, even if you pay it on time. That's important. People think paying on time is enough. It's not. High utilization tells the algorithm you're leaning too heavy on debt. The sweet spot is below 30%. That's where lenders get comfortable. And here's the crazy part. This is one of the fastest things you can improve. Pay down debt, wait 30 to 60 days, and your score can rise surprisingly fast. But what most people do instead is apply for more credit. And that backfires because now the system sees high utilization plus new credit applications plus more borrowing. Now you look stressed. That's why credit hacking, it's such a trap. The third factor is credit history and makes up about 15%. And longer history helps you. So that old credit card you opened when you were 19, don't close it. I don't care if it gives terrible rewards. I don't care if you never use it. Leave it open. Because the longer your average credit history, the safer you look. People accidentally hurt themselves by constantly replacing old cards with new, better ones. The banks don't care about your rewards. They care about your stability. The fourth factor is public records. Collections, bankruptcies, consumer proposals. This makes up to 10%, but realistically, the impact is way bigger than 10% because by the time someone reaches this stage, there's usually damage everywhere else too. Late payments, higher utilization, missed accounts, and here's the part that no one wants to hear. Consumer proposals are not the magical, easy solution people market them as. They can stay on your report for years, and recovery, it takes time, real time. The fifth factor is inquiries. This is where the internet destroys people. Every time you apply for credit, the system asks why. 1 inquiry, not a huge deal. 12 inquiries, we got a problem now. And this is why constantly applying for rewards cards quietly crushes people, because lenders don't see travel hacking. They see instability. Now here's the important distinction. Mortgage shopping is different. If you talk to a bank, then a broker, then another lender, those typically group together. That's normal shopping behavior. But applying for random credit you don't need, that hurts you. So what does a strong score actually look like? Over 680, you're generally in a good shape. Best rates, best options, best flexibility. 620 to 680, it's a gray zone, still workable. Below 620, now things start getting difficult. And below 550, there's usually significant damage happening. But here's the good news. Credit, it can improve with time, faster than people think. If you make payments on time, you reduce your utilization, and you stop applying for more credit and keep your history clean, you can dramatically improve your score over time. So here's the action plan. Make every payment on time. Keep utilization below 30% and stop applying for the fucking cards. Keep your old accounts open. Avoid collections at all costs. And check your real credit through Equifax or TransUnion, not the apps trying to sell you more debt, because your credit score affects everything. Your mortgage approval, your interest rate, your monthly payment, your borrowing capability and power, and your future flexibility. And the difference between a great score and a damaged score, it can literally cost you tens of thousands of dollars over your lifetime of your mortgages. That's not dramatic, that's math. And if you're thinking about buying a home, refinancing, or renewing your mortgage in the next couple of years, what you do today matters more than what you do when you finally apply. Because by then, the banks are just reading the story you've already wrote. And when you're done with this one, check out my last video covering the current situation with the Bank of Canada. I'll see you there.